Fundamental indicators.
The global economy moves on numbers. But here's something wild. Just 7 key indicators can predict nearly every major market shift we've seen in the last decade. Let me show you why these fundamental indicators matter more than you might think.
That's fascinating. I had no idea such a small set of indicators could have that much predictive power. What makes these particular ones so special?
Well, let's start with what I consider the heavyweight champion of economic indicators, the monthly U.S. non-farm payrolls report. Every first Friday, it's like the whole financial world stops breathing for a moment.
Mm-hmm. And it's not just about job numbers, right? There's so much more hiding in that report.
Exactly. We're talking about a complete snapshot of the labor market. Payroll levels, unemployment rates, wage growth, it's all there. And here's what's really interesting. Just a 0.1% surprise in wage growth can send markets spinning.
Speaking of big market movers, how does GDP fit into this picture? I mean, it's the granddaddy of all economic indicators.
Oh man, GDP is like the ultimate economic scoreboard. When it rises just 1% above expectations, currencies can jump by hundreds of pips in minutes. But here's what most people miss. It's the revisions that often pack the biggest punch.
That's such an important point about revisions. You know, I've seen markets completely reverse course when previous GDP numbers get adjusted.
And that brings us to something really fascinating, the trade balance. Think of it as a country's economic report card against the rest of the world. When a country has a trade surplus, it's basically winning the global economic game.
Well, that makes me think about inflation and the CPI. These numbers have been making headlines everywhere lately.
The CPI is crucial because it affects everything. A jump of just 0.2% above expectations can force central banks to completely rethink their interest rate plans. And speaking of central banks,
Oh, yes, their statements have become like this elaborate code language, haven't they?
exactly. When central bankers turn hawkish, it's like they're signaling a green light for currency strength. But here's what's fascinating. Sometimes just changing one word in their statement can move billions in market value.
That reminds me of how the Purchasing Managers Index works as this early warning system. How reliable have you found it to be?
The PMI is incredibly reliable. It's predicted 85% of economic turning points in the last 20 years. Think about it. These purchasing managers are literally on the front lines of economic activity.
That's an impressive track record. And I imagine these indicators all work together in some way.
They do, and that's where it gets really interesting. Let me give you an example. When PMI jumps unexpectedly, it often leads to higher employment numbers within 2 to 3 months, which then feeds into stronger GDP growth.
So it's like this complex economic ecosystem where everything's connected.
Exactly, and timing is everything. Some indicators, like PMI, are leading indicators giving us a peek into the future. Others, like GDP, confirm trends we're already seeing. It's like having different pieces of a time machine.
That makes me wonder about how different countries might focus on different indicators.
While export-heavy economies like Germany and Japan watch trade balance numbers like hawks, while the US tends to focus more on consumer spending data. But here's what's fascinating. These priorities can create global tensions.
How so? Can you give an example?
Sure, when China manages its currency to support exports, it directly impacts US manufacturing PMI numbers. Last year, a 2% change in the yuan led to a 5% swing in US manufacturing activity.
That's incredible how these ripple effects work through the global economy.
And that's why understanding these indicators is so crucial. It's not just about the numbers, it's about how they interact and what they tell us about future economic movements.
So, what should people really focus on when looking at these indicators?
Look for the unexpected. When employment numbers are strong but wage growth is weak, or when GDP is up but PMI is falling, that's when things get interesting. These disconnects often signal major market moves ahead.
That's such valuable insight for anyone trying to make sense of economic data.
And here's one final thought. These indicators aren't just numbers on a screen. They represent real economic activity affecting millions of lives. Understanding them helps us understand where the global economy is headed.
That's a perfect way to wrap this up. bringing it back to the real world impact.
Absolutely right. Whether you're a trader, investor, or just trying to understand the economy, these fundamental indicators are your roadmap to what's coming next. They've predicted every major market move in the last decade. We just need to know how to read them.
Economic calendar.
The financial markets can swing by hundreds of billions in mere minutes after major economic news. But what if there was a way to see these massive moves coming? Today, we're diving into a tool that's like having tomorrow's newspaper today.
Oh, wow. That's quite a claim. How could anyone possibly predict those wild market swings?
Well, it's fascinating, actually. There's this thing called the economic calendar that professional traders use to anticipate potential market volatility. Think of it as a sophisticated radar system that tracks all the major economic events that could impact financial markets.
Hmm? You mean like when the Federal Reserve makes those big announcements that seem to shake up everything?
Exactly. And here's something mind blowing. In 2020, just central bank meetings alone caused average movements of 150 pips in the forex market. That's like the entire market collectively holding its breath, and then, boom, everything moves at once.
That kind of volatility sounds both thrilling and terrifying. How long do these wild swings typically last?
That's one of the most interesting parts. These high impact events usually create heightened volatility for anywhere from 30 minutes to 2 hours. But here's the catch. During these times, you might see some crazy price jumps and much wider spreads than normal.
So it's not just about knowing when these events happen, but also understanding how to protect yourself during these volatile periods?
Precisely. Let me break down how traders actually use this calendar in practice. Most professionals start their day by checking what major economic events are coming up. It's like checking the weather forecast before planning an outdoor event.
Well, that makes sense. But how do they know which events are really important versus just routine announcements?
This is where it gets really clever. The calendar uses a color coding system. Red for high impact news that could really shake things up, orange for medium impact, and yellow for lower impact events. It's basically a built in risk assessment system.
That's quite brilliant, actually. But what exactly makes an event high impact?
Think of things like GDP reports, inflation data, and those big central bank meetings we mentioned earlier. These are the events that can fundamentally change how traders view a country's economic health and, by extension, its currency value.
You mentioned earlier about those 150 pip movements. What exactly does that mean for someone's trading account?
Well, to put it in perspective, a 150 pip move on a standard lot of currency could mean a swing of $1,500 in your account, either as a profit or a loss. That's why understanding this calendar is so crucial for risk management.
Oh my goodness. So you could either make a killing or get absolutely crushed if you're not prepared.
Exactly right. And here's something most people don't realize. These calendars don't just show when events happen. They also display three crucial numbers: what analysts expected, what actually happened, and what the previous reading was.
So it's really about comparing expectations versus reality?
You've got it. And here's a pro tip. Sometimes the market's reaction isn't just about whether the news is good or bad, but about how different it is from what everyone expected. I've seen cases where seemingly good news actually caused markets to drop because people were expecting even better results.